Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 33.72%, and it's beating the S&P 500 since the portfolio started. And our dividend growth stock portfolio has an annual return of 21.24%. It too is beating the S&P 500. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,357.26 after 138 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now this week, I've added a tan line to the chart that shows our cumulative investments. In our first year, 2022, stocks did not do well, and as you can see, our portfolio had overall losses where the blue line dips below the tan line. But the power of compounding is working in our favor now as the portfolio really took off in November of 2023. Also new this week, or at least it's been a while since I updated you on the technology portfolios. Later in the video, I give you an update on those technology portfolios, something I've been negligent about since I'm personally using the dividend portfolios, and that's where my biggest interests lie. Technology stocks in general have not been doing well lately, so I assumed our tech portfolios have been lagging as well, but they definitely have not, as you will see later. In fact, one of our technology portfolios has been outperforming all of our portfolios since it was started back in April of 2029. April 29 of this year. And that surprised me when I saw those performance numbers. And for those that have been asking, I'm looking to put details of the dividend portfolios on my website as well as real-time notifications, but I'm looking at new website platforms that are more mobile friendly. But I'll keep doing these weekly videos as a free option for those who don't mind getting the picks a week late. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting about 2.5 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings and investing goals and get ideas of company names that they can do their own research on. As always do your own research. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, as I mentioned earlier, the market did not perform well, and bonds didn't do well either. It was a really bad year. But because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,357. The portfolio, the dividend growth portfolio's return has been 21.24% per year. Last year, the dividend growth portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those in retirement or nearing retirement. The table at the bottom of this slide shows the portfolio comparison when both portfolios existed because they were both started at different times. The high yield portfolio was started in August of 2023, and the annualized return so far is a crazy 33.72%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 22.52% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks so far. That's not by design, that's just the way it's worked out so far. But time will tell which one does better. If an investor was solely investing in the high yield portfolio, I personally would think about supplementing it with some tech stocks for additional diversification. Now remember, the high yield portfolio has only existed for a little over 12 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio's return. This slide shows the growth of the dividends we have received in our dividend growth stock portfolio so far. The graph shows the cumulative dividends we've received, and our dividends for the last quarter increased 51% over the previous quarter, and our dividends this last month increased 41% over the same month a year ago. So why do we only invest in dividend-paying stocks in our main dividend growth fund? The first reason we stick with dividend-paying stocks is, according to Hartford's study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks over the same time period, the average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I include at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927, yes, that's even older than me, and came up with the same conclusion. Dividend-paying stocks has a higher return and less volatility. I should say dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. The second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. Why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, meaning the more up and down, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom dividend portfolios only invest in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Now, here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 per year. The company has quickly grown the dividend to the point where the yield, based on my original investment, is now 8.13%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividend well into the future. If not, that's why we have constructed a diversified portfolio in both of our dividend stock portfolios. This is the power of investing in a quality dividend growth company. My second example of a high-quality company with a history of raising its dividend is Home Depot. 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time, and Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning that for every $100 I had invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield now, based on the original investment, is 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds. But you certainly won't find a bond that pays anywhere close to yields on the original investment that these two stocks are paying, and bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $61,625. These amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get the final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? The next slide explains that. The main reason why we invest only $12.50 per week in the portfolio is because I wanted to show my accounting students that you don't need a lot of money to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, now allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. I wish they'd done that back in the day when I started originally investing. Now, originally I invested $25 per paycheck into this Dividend-Growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class for these dividend portfolios is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year is assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For our classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. And in year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's annual return is 21.24%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 11.54% per year, a difference of 9.7% per year. Our high yield portfolio is also outperforming SCHD, but by an even larger margin of 10.3% per year. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate. But I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach, where no one is overseeing the stock selection. SCHD has at times had large positions in stocks I consider to be a value trap, and that's not a good thing. So this slide shows our best performing stocks in our dividend growth stock portfolio based on when they were initially purchased. Evercore Investment Bank moved back into first with a 201.8% total return. A return of 200% means it has tripled since we bought it less than 2 years ago. Eli Lilly moves back into the top 15 with a 66.3% total return in 8 months due to the effectiveness of its weight loss drugs. Stocks in yellow have been sold. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's look at the column called strategy. Specifically the category called dividend growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing the dividend payouts to investors. The other 10 or 11% of investments so far have been invested in usually smaller, under the radar companies that have recently started paying a dividend. These under the radar dividend paying stocks tend to be riskier because they are usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. Examples on this slide are F&G Annuities, Repositrac, and Finia. This slide shows our best performing stocks this week. Last week, we saw a 24% increase in Starbucks in one day alone, and the same thing happened the week before with Clear Secure Incorporated. But this week, our biggest gainer was the lithium producing company Albemarle. This week in the overall market, the best performing stocks were small cap stocks, meaning just basically small stocks, with an average gain of 3.4% just in that week. And microcaps, which are the tiniest of the stocks, they were up 4.3% last week. So you'll see that a lot of our smaller stocks did very well this week too, led by Bowlero's 10.3% gain and Adcore's 7.5% gain. Here's the usual financial disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own diligence, which is a fancy way of saying do your own research. We don't sell stocks often in the dividend growth portfolio, and this week was no exception as we made no sales. Now let's talk about the dividend growth stocks we bought last Monday. Here are my ratings for the top 15 dividend-paying stocks this past week. At the request of some viewers, I expanded the list to 15. We purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in the yellow highlight have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Because so many of our stocks saw their prices rise so much the previous week, such as the aforementioned Starbucks one-day increase of 24%, many aren't quite as good a bargain as they were prior, so this week our list of top 15 dividend stocks changed a lot. In fact, we had 4 stocks that we made our very first purchases in, and they were Lamb Weston, the potato supplier, M&T Bank, Constellation Brands, and Qualcomm. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends in the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued, or maybe even reinvesting in a stock that you might be selling pretty soon. This table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Lamb Weston, PNC Financial, Constellation Brands, and Qualcomm. Remember, all these stocks pay a dividend and have recently increased their dividends, and their methodology used here indicates they are likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields were, in order, Bristol Myers, PNC Financial, Morgan Stanley, and M&T Bank. Now, I messed up the spelling of M&T Bank's name, and we'll need to fix that. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in those smaller, under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown, like we mentioned before, they historically beat the market averages by a significant amount. Now, all the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component on this slide, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantage the company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look at red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. Now, earnings are also called profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest first looking at Nike, Microsoft, and FactSet. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are MasterCard, Visa, and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Bristol Myers, Lamb Weston, PNC Financial, and Morgan Stanley. All these earned an A or A+ grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Bristol Myers and MasterCard. These two stocks earn an A- or better grade. The companies with the best combination of recent dividend increases and potential of future dividend increases are Bristol Myers, MasterCard, Visa, and Lamb Weston. On this slide, we're looking at the stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a lowly teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6%, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, Martin Marietta announced this week they will increase their dividend by 6.8%. The last 17 dividend increases for the portfolio have an average of 9.6%. NVIDIA's huge dividend increase fell off of this table. They're number 18. That's why the average has come down. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, the shares held, and dividends paid per share that we've received once the stock split has occurred. Now here's a look at the 10 stocks that make up the largest portion of our dividend growth portfolio as of Sunday. Our top 10 holdings list this week did not change much, as Allegiant and MasterCard remain at the top. Comcast did move up a spot past Microsoft. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor. Therefore, we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock portfolio's allocation. But that also creates a more concentrated, more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at the highest ever at 101. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that was time consuming was creating the spreadsheet. That took me about 2 years to do and was quite challenging. I have a feeling we might be selling a stock or two in the upcoming week, but that's just a guess. Now let's talk about our high yield dividend paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts in this new portfolio. The portfolio as a whole has an annualized total return of 33.72%. Now, since the portfolio has been in existence for nearly 13 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which has existed for over 2.5 years. Currently, the high yield portfolio's dividend yield is 4.17%, which took a dip this week as the portfolio saw a nice gain. But the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we've invested to 4.89%. Now, 2 strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features higher yielders, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds, high yield and dividend growth. Hard to do, but that that strategy 2, so far is a better performer, likely because of the good performance of its utility stocks lately. Strategy 1 does not have any utility stocks in it. The average investment in strategy 2, the better performer, has provided a total return of 16.15% and has been held for an average of 169 days so far, which is an annualized return of 38.2% using Excel's rate function. Now, it's not likely the portfolio can keep up an annualized rate that high since his stocks historically average about 9 or 10%. On this slide, we're looking at the high-yield dividend-paying stocks we bought this week. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchased 8 stocks for this high-yield stock portfolio. And as mentioned before, we have 2 different strategies within this portfolio. Strategy 1 is the one that emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to be greedy and try to get the best of both worlds, that being high yield and dividend growth. Because there are 2 different strategies, we have 4 stocks in strategy 1. Those are in red. And 4 stocks in strategy 2, those are outlined in green. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2, and that often happens. If that's the case, instead of a stock getting a 1/8 weighting, they get 2/8, which is equal to 1/4, which is equivalent to 25% of that week's investment. Both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The 4 high-yield stocks we bought this week while implementing strategy 1 are Bristol Myers, Chevron, PNC Financial, Strategy 2, it's Bristol Myers again, PNC Financial again, M&T Bank, again I screwed up the spelling of that, I'll fix that, and Morgan Stanley. This week's purchases have an average yield of 4%, with Bristol Myers coming in the highest with a 4.9% dividend yield. Here's a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. Now, it's been a while since I updated in the videos about our two tech portfolios. Because my students love technology stocks, we started two technology portfolios this year. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. So far, the portfolio has increased 23.49% in less than 9 months. In comparison, technology ETF with the ticker symbol XLK is up 16.75% over the same time period. Best performers are NVIDIA, Pure Storage, Broadcom, Meta Platforms, SAP, and Fortinet. As mentioned before, many of my students are extremely interested in tech stocks and have requested that we rank them separately from the dividend-paying stocks each week, even if the tech company does not pay a dividend. Many students, as you can imagine, find the tech stocks to be more exciting than dividend-paying stocks. So we started a second technology portfolio. Back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. Now, I hesitate to call this a portfolio since it's limited to only one sector, but so far it has been kind of fun to follow. So how is this portfolio different from the $1,000 technology portfolio shown on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that aren't technically in the technology sector. For example, Google and Amazon. Neither of those are officially tech stocks. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. So you're not going to see Google or Amazon in this portfolio. The average investment so far has been held for 64 days, because remember, we started this on April 29th of this year, but has produced an average total return of 9.4%. Now this is where it gets crazy. Using Excel's rate function, that's an insane 66% annualized return. Obviously, there's no way it can sustain that rate of return. But our goal here is simply to see if we can beat the return of technology ETF XLK, called the Spider Technology Select Sector Fund. If we'd instead invested our weekly investments into XLK, instead of a 9.4% average return over 64 days, we would get a return of 3.8% with the same average holding period. So far, no sales have been made in the portfolio yet. Note that these stocks are higher quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks or other types of dividend stocks, because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc., but we use the valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. So the top four tech stocks this week, according to our system, our methodology is Taiwan Semiconductor, Microsoft, NICE, and Shopify. So that's it for this week. In the comments, let me know if you have any questions, and also let me know what other types of investing videos you'd like to see. Finally, here are the places you can reach me. YouTube, obviously, as well as X and LinkedIn, and my website, beatthestockmarket.com. I'll see you again next week with a list of stocks we will have purchased on Monday. See ya.